Wes-tone here. In this video, we're going to take a look at Bitcoin dominance through the lens of the wealth cycles strategy. And by the looks of this chart, it looks like we have some pretty decent cycles happening here. So let's just get to measuring. So actually, we want the full wavelength, which is very, very close to 4 years, which is somewhat known in the Bitcoin world with having a 4-year market cycle. So it looks like that 4-year market cycle generally kind of holds here too. But that just gives us our initial rough estimate at the cycle wavelength. Our cycle is very approximately, we'll say 208 weeks. So now what I'm going to do is take my simple moving average. We're going to take 1/4 of the cycle length or cycle wavelength, which would be 52 weeks. And we're going to offset it by -1/8 of the wavelength, which would be -26 weeks. And time frames weeks again. And when we do that, we get as smooth of a sine wave cycle trend as we can possibly achieve. And now I can get a little bit more accurate measurements because now I can take from the actual peak of the cycle low instead of the nominal low and measure to the cycle low here. And that's very close, just a little bit over, again, 208 weeks would be 4 years. So this looks like it generally jives with the Bitcoin 4-year market cycle. Now this gives us some interesting information because if we're just looking at price, we might draw something like this, which might lead us to thinking that we have a channel that looks something like this, or even potentially a channel that looks something like this if we're just using nominal price action. But using the cycle to draw trend lines would suggest something more along the lines of this. And I think identifying the cycle is the most important, since that is, in musical terms, its fundamental frequency. That gives us the clearest signal of price action. The nominal price has all sorts of short-term noise, which you can see, which we can use to our advantage only if we have correctly identified the base cycle. You know, cycles are inherent in physics. And in my experience, at least, this is a more effective form of technical analysis. You know, head and shoulders patterns, trend lines, wedges, etc. are not fundamental to physics. They are arbitrary illusions of the mind of man and continually fail over and over. Okay, I'll redact that statement slightly. Trend lines and channels can be applied pretty consistently to sine waves. So I reserve my technical analysis to the fundamental signal that the price chart is giving me, which by the looks of it, we should be turning the corner here very soon if we've correctly identified the cycle. And the cycle is the most important because if we can identify that confidently, then we can be much more confident in trading divergences from the cycle. Like for instance here, notice how the price diverged dramatically from the cycle. The Bitcoin dominance was just about 25% above where the cycle should have been. And look at that, caused a dramatic move. If you had been able to identify this during this trend and fade into this move, you would have seen astronomical returns during this violent move, which only took place over the course of about 3 months. I think we're setting up for something very similar here at this moment in the Bitcoin dominance market cycle. And now would be a good moment to briefly discuss the philosophy of trading. I believe that in a free market economy, you make money by providing a valuable contribution to society. So have you ever wondered, what is the contribution that traders make to society? Traders can make a lot of money. So what value are we fundamentally contributing? Traders are just a bunch of greedy a-holes and degenerate gamblers, right? I've thought about this question
And the answer that I've come up with is that as traders, our contribution to society is to reduce market volatility. And if you think about it, good traders reduce market volatility and they get paid very well for it. Bad traders increase market volatility and lose money doing so. So what that means is if we can identify the fundamental signal, then we can more accurately identify volatility. And then what we can do is we can fade into this move and fade out on this move, thereby putting pressure on the nominal price and squeezing it closer to the fundamental market cycle. And stable markets are much healthier for the economy at large because more stable markets means more predictable business decisions, etc. So our contribution to society, the value that we add is that we create more stable markets. And so when we're looking for extreme divergences and putting pressure on them to improve market stability. And that's why traders will flock to volatile markets because that's where they make their money. That's where they're needed.
So I'm just going to take and draw these curves here, which represent a little bit more of a perfect sine wave. And then I just look for divergences from where the moving average diverges from this cycle. And because it looks like we had a little bit of downward pressure on the price here, that means we're probably going to have a little bit of upward pressure on the price here, which seems to be happening. Our moving average trend will probably look something like this, where we have a little bit of underperformance here, a little bit of overperformance here. But generally, I'm expecting it to follow this market cycle curve. Unless, of course, we've drastically misidentified the cycle, then, hey, who knows? Who knows what's going to happen? What's happening here looks to be like a capitulation. We're having our price just veer off dramatically from where the market cycle appears like it should be going. These are the kinds of opportunities you want to see, a late market cycle extreme divergence, because these are going to set up for the most explosive moves. You have to think of the cycle wave as like having a magnetic pull to it, because that's what it is. It's essentially a electromagnetic pull, where if you can correctly identify the cycle, then any price divergence from that in any sort of extreme way has somewhat of a slingshot effect. If it overshoots one way, it's going to overshoot the other way. And we're setting up for a fairly violent move in altcoins after some sort of capitulation. Another thing to note is that as the cryptocurrency market cycle matures, we get less and less volatility. So the first trough was extremely volatile. The first crest here was also very volatile, but I would say slightly less volatile. We had a way overshoot here. We had a bit of a undershoot here, followed by a massive overshoot here. And then ultimately this massive move in a very short period of time. So we had this peak, which was very late in the cycle, and this bottom, which was very early in the cycle. And then we kind of just held support here as we rounded the bottom. So far, this leg of the cycle has held the cycle very closely. We haven't really had any extreme divergences, maybe a little bit of an under divergence here. Until now, it looks like we're starting to get that sort of altcoin capitulation just before altcoin season comes and slingshots altcoins into next, say, summer, fall, early 2026. By the way, we can take the center of this low and measure it out 208 bars, and that puts the Bitcoin dominance trough in approximately spring of 2026. So let's just analyze this. This price diverged about 25% from the market cycle. From here, we were approximately also about 23-25% from the market cycle. This particular move here, we're approximately 12% above the market cycle. Given the maturity of the crypto market, I would say a 25% divergence is probably impossible at this point, or so unlikely that it's just not worth mentioning. That would be, unless of course we've incorrectly identified the cycles, because we really only have, right, you could maybe say 2 full cycles or a cycle and a half's worth of data. So therein lies the risk. Therein also lies the opportunity if we can correctly identify it early on. So again, as we get more data on this moving average, I'm fitting these lines to fit the moving average is essentially what I'm doing. And then I'm just finding the pattern and extending it out into the future. One other thing we can do is we can measure from this cycle low to this cycle low, and we get about negative 14%. From this market cycle, we've decreased from the current levels is about 18%. A 14% decrease trough to trough. A 17% decrease so far, peak to peak. Now, if the 14% thing holds, that's going to put us approximately at a 56% Bitcoin market dominance, put us at something like this. So either way, whether we do that or whether we follow the trend line, either way, it puts us pretty close, right? And this is where you don't want to use leverage, because leverage decreases your resiliency to volatility. Because in the end, I don't know, you don't know, we don't know. But look, if the cycle peaks at 56% or 55% or 54%, it doesn't really make that much difference in the end, unless you are so incredibly over leveraged that you just can't withstand a certain amount of loss or volatility. So now what I've done is, instead of trying to fit it to the moving average, I've measured from this peak out 208 weeks, which puts the market cycle here. When I shift the cycle over slightly, that makes this moving average divergence look more significant, and therefore we could see a more significant move out here. In the end though, by late winter, it looks like we should definitely be rounding the corner. If not any time between now and then, we should be rounding the corner. And just going a little bit deeper on some of the arbitrary technical analysis here. So assuming these cycles are true, here's a few possibilities I could see happening. So because we're kind of overshooting on the extreme now, that what tends to happen is that we'll overshoot on the extreme in the other direction. So I could see us by springtime overshooting from somewhere up in here to here. And now pay attention to where my trend line is relative to the cycle, right? Because we're diverging from the cycle in this direction. We're probably going to overshoot the cycle in this direction. This level here corresponds with the nominal low of the previous 2 troughs. And so I'm sure there will be plenty of people who sell there psychologically, right? So we get a bounce. That takes us through next summer, but the cycle's not complete yet. So we might get an opportunity sometime during the next summer, before altcoins really destroy Bitcoin, into the fall. And we also take out this low here. That'll wipe out a lot of traders who are using that level as support, and we'll get a huge breakdown here. But we can really only take it one day at a time, one cycle at a time. No sense in getting too far ahead of ourselves until we see what the market actually does. Let me know what you think in the comments below. What's your interpretation? And how do you think this plays out? What am I missing? Thanks for letting me know. See you guys.